Happy belated Valentine's Day, everyone. My son and daughter could not be more different. My 10-year-old daughter, it was the only one in her classroom to hand make all of her Valentine's Day cards, one for each of our classmates. My 8-year-old son, guess what he did? He prepared nothing. He went to school empty-handed and came home with all these lovely treats. He did not even want to go to the dollar store to pick up some pretty awesome Valentine's Day cards with badass Marvel or DC superheroes on them for the cheap. We would have paid for them anyways. Yeah, by the way, Valentine's Day cards are so much better than they used to be. Superhero Valentine's Day cards, so jealous. My daughter, thoughtful. My son, thoughtless. Oh, how hilarious it is to have a child of each sex. The sad part is I see so much of myself in my son, which makes me laugh and disappointed in myself. Speaking of family, Cherry Chan, real estate accountant, and I are celebrating Valentine's Day on the Friday after February 14th, as we're just too darn busy between work and the kids having after-school programs 6 days of the week. We're not getting things done on time. So we're going to go for a couple's foot massage so we can chit chat while that's going on. And we'll go for dinner at the Racket Club where it's easy to get a table. Also the meals are subsidized by the club membership. So I'm frugal. If the massage goes well, we may make this a regular thing for our date night. Again, it's super cool that we get to, relax, and I have a lot of issues with just from getting old, and also I could use a lot more help for my ankles that are pretty beaten up from all the basketball I used to play. And one of the masseuses that we're getting tonight is also registered, so we're getting a receipt for our benefits. Thank you for everyone who tuned in last week of Epic Fail episode 2, because that was our most downloaded episode of the year so far. This is the Truth About Real Estate Investing show for Canadians, the number 81 ranked business podcast on all of iTunes. And we've been going at this since 2016, so well over 300 interviews, interviewing many of the best investors and best-selling authors in Canada to learn about what makes them tick, their tips, tricks, and most importantly, the lessons, including from loss. So we may learn as a collective, all of us, you the 17 listeners and myself, we are able to learn to better apply better practices to our own investments and our own lives. Now back to Epic Fail episode 2. The more I read and hear about the situation, the worse it sounds. A friend of mine who invested with the group, seeking bankruptcy protection, shared with me the address of the subject investment property. And you know the saying in real estate? Location, location, location. Well, the location is just terrible. The property is located in a rough industrial area. It's a residential property, apparently a duplex. So it's residential. People live there, and it's located in an industrial area near an active train track that's frequented by both GO and VIA train, and I'm gonna guess freight trains as well, because I can see how busy, how many rail line goes right into the States. So it's likely high traffic. In front of the house and behind the house are car mechanic shops. So you know how loud those can be. And if that's not enough, also behind the house is a street hockey and street hockey business, something like that, and an outdoor rink. So as long as peaceful enjoyment of your property is not important to you, you're good to go. Unfortunately, the market does not look favorably on such locations. Appreciation will be stunted below market. So please always do your own due diligence. I do not care what anyone says or endorses about the property. I do not care how many Instagram followers they have. I do not care if they speak on stage or have their own podcast or guests of other podcasts or owns 400, 600, 800 doors. Prove to me you can make money. And all this due diligence, all this location stuff I told you about the property, I was able to do it from the comfort of my desk while using Google Maps. On the personal real estate front, I have an accepted offer on one of my own properties. The inspection was yesterday. I just answered a bunch of questions on it. They're all pretty benign. My Hamilton student rental, where the sink just 2 weeks ago decided to leak. To delay being listed. It's as if the house knew of what was happening and forced delays. In all seriousness, the house is 100 years old, so things will break and whatnot. So I had a lead fitting leak, so I got that fixed. Everything's all patched up. house is available for sale now. I have links in the show notes should you be interested in having a look. Because the reason why I'm selling them now as well is that these are student rentals. So the market is on absolute fire. There's nothing to buy out there, and there's nothing to rent either. So I'm trying to take advantage while the supply situation is incredibly sad, and the demand is high for both rental and for property to buy. Because if you can't find something to rent, I'm hoping a rich parent will want to buy this house for their kid to live in, so they actually have somewhere to live. I am one step closer to owning property in the landlord-friendly states of the USA and getting towards my goal of generating $100,000 cash flow, which is my long-term goal. Again, I have links in the show notes to my listings. On to this week's show. Our guest should need no introduction. It is my lovely wife. This is the Valentine's Day episode. So my lovely wife, the real estate accountant, Cherry Chan, is our guest. Cherry Chan is here to share about the convoluted changes by our federal government to seem to know. They seem to want to know more about our real estate. They keep coming up with half-baked ideas only to delay. It's funny because like the deadline's coming for filing, and then they delay. Another deadline's coming up, and then they delay. While I actually had a friend had to pay his accountant overtime to get his underused housing tax filing completed on time. The government's making us jump through hoops. All this make busy work. It's really complicated stuff, but Cherry is a talented messenger who can explain what the Trudeau Liberal government is doing at a level that at least I can understand. We also chat about lessons from our portfolio, owning through properties through the downturn in the real estate market, how we are refocusing to at least cash flow neutral on properties, hence the decision to diversify to the landlord-friendly states of the USA. I'm hoping Cherry and I can take that trip to the south together, to Georgia and Tennessee in May after tax season. Romance and cash flow, two of my favorite things in life. I hope you had a wonderful Valentine's Day and find more cash flow in your lives, because please never forget, cash flow is what affords you freedom. US dollars are also worth more than Canadian dollars. Please enjoy the show. Happy Valentine's Day, my Valentine. What's keeping you busy these days?
Definitely not Valentine's Day celebration. These days, our business has been focused on essentially two things. One is to gear up, preparing for the upcoming tax season. We're expecting to have a lot of filing obligation that we need to fulfill for the latest rule change, particularly all the trust relationship that we now have to report to the government. So that has to be done, and is a new rule that was just implemented and started last year, January 1st, 2023. And the first deadline is April 2nd, 2024. So we have a deadline coming up, and we're trying to essentially have everyone trained and prepare for the upcoming tax season.
Are investors excited to be able to have to do more reporting to our government?
Yeah, it really sucks. Over the last few years, it has been change after change after change. I think in 2022, for properties owners that own properties triplex and under, if they own it in a trust, in a partnership, or in a Canadian corporation, private corporation, then they also needed to file something called underused housing tax form. And although that was completely eliminated for as of December 31st, 2023, it was eliminated. But then
for the year or going forward?
Going forward. For not eliminated as in you don't have the filing obligation, because Underused Housing Tax Act, when it was first introduced, it was really targeting non-residents. But the way that the act, the Underused Housing Tax Act was written, it was including people who are Canadian corporations, Canadian partnership, and Canadian trust. These people, they're all Canadians. They're not non-resident, they're not Canadian, they're not non-resident, non-Canadian citizen. So these people, because of the way the act was written, they all have filing obligation. Now they clarify the rule and say, hey, like if you are a Canadian resident or Canadian citizen, mostly Canadian citizen, you own your properties through a corporation, you no longer need to file for December 31st, 2023, but you would still have filing obligation for the previous year. So it gets really confusing, but that's practically gone unless you own that property as of December 31st, 2022. Then you have filing obligation, you still should file for it. If you miss it, and the penalty would still be there, $10,000 for Canadian corporation, $5,000 penalty for Canadian person.
How much does it cost someone to file?
It could be anywhere between $500 to $700 per form. That seems...
Sorry, we need a form per...
property.
That's a lot.
Yeah, like you can do it yourself too, but then you have to go through and understand it and get the proper number and do the filing. You need to know that you're doing it right. Our team had gone through lots and lots of training just to get the better understanding and make sure that we interpret it the way that it's being intended. And so majority of accounting firms out there are charging like going rate of $500 to $1,000 per form. And some people would just do it by themselves, which is totally fine as long as you feel that you're capable and you are able to do it. So that's gone. The fall economic update done by the federal government basically removed that filing obligation for 2023 and forward. But then it was replaced by this trust reporting rule that we mentioned earlier. And this trust reporting rule, it casts a different net. But basically, it requires anyone that is in a trust relationship to file something called a trust return. Whereas previously, if you have a trust relationship, you're not necessarily required to file a return if there is no income passing through. So right now, this new rule requires specifically bare trust arrangement to be reported to CLA on an annual basis.
So in plain English, who needs to file for this?
In plain English, there are some common examples. Number one is people who have family trust. So if people who have family trust. But even though people have family trust, you and I have a family trust last year. We just set one up. That family trust, even though there is no income going through, in the past you didn't have to file. This year you will have to file. That's number one. Number two is if you have a trust agreement signed. A lot of real estate investors out there are using this trust agreement to buy properties in trust for a corporation or in trust, or buy it in the corporation in trust for them. So this type of relationship, they have a bare trust agreement that's signed. Those people, you would have the filing obligation. Those are really simple one. And then there are people who own properties in a joint venture relationship. Now, those people who sign a joint venture agreement, you could be the one that's on title, but then you and I are actually reporting income and expenses, assets and liabilities 50-50. So there is a joint venture relationship happening between the two of us, but you're the one that's on title. My name is not on title. So that is also a trust relationship because you own 50% of the property in trust for me. So now there is a trust relationship and there is a filing obligation. Another common one is we don't have anything formalized. You and I, a couple, one of us make more money than the other person. So that person go on title. Both of our name are on title. But only the lower income spouse is reporting 100% of the income and expenses. The higher income spouse is only going on title, essentially to help to qualify for the mortgage. Now, there's no formalized agreement, no trust agreement, no joint venture agreement signed. Typically, it happens between spouses. And there's also a trust relationship because your legal title ownership does not equal to what you report and how you file on your personal income tax return. And so therefore there is a trust relationship, and so you have to file. Another common example is parents go on title to help their kids to qualify for financing if they were to buy a property for their own home. They don't own any properties.
Is that usually investment property or for
No,
someone's home?
could be on their own, for their own home, like their own. The kids are buying their first home, can't qualify for financing. The parents go on title just to help the kids to qualify for financing. It's also very common.
I know it's common, but there doesn't need to be a trust agreement in place?
There would not be a trust agreement. People just go on it because it's family.
Okay.
There's no trust agreement signed.
Yeah.
Although the trust relationship exists.
Got it.
Yes.
Oh, I see. So it doesn't necessarily need to be a trust agreement in place. The trust agreement is there.
If you have
to be a contract necessarily.
Yeah. The trust agreement just formalize it, but the trust relationship would still exist.
Got it.
Yeah, without an agreement.
Yeah.
Now, so this applies to not just properties. So far we have only talked about properties investment. It also is also applicable to cash account, investment account. There is an exception if your cash account that you own in trust for someone else is under $50,000 and the account balance is in cash or in publicly traded stock, then you don't have to file. But if it is over $50,000, or if the underlying investment is not cash or publicly traded stock,
right,
then you would still have that filing obligation. So I could be owning a crypto account in trust for you. And my name is not that I do, but if I owned that crypto account,
right,
even if it is under $50,000 and I own it in trust for you, then I have that filing obligation.
Right. So the government wants a whole bunch of visibility into what we own.
Yeah, so this is also universal between Canada and US. US is also asking, IRS is also asking for the same information as well.
At the same time that we're doing it?
Yes.
Oh, okay, interesting. Mm-hmm. That news doesn't make it into my feed. and then how much? And then how do people know generally? It's generally people's accountants generally are the ones who are triggering to let the client know that they have a trust filing that's required.
I think it is really difficult even for accountant to know all of the trust relationship around someone's life, right? Like example is you go on title to help your kids qualify for mortgage.
You may not tell your accountant. Yeah.
You won't tell your accountant, or you go on title to help your parents to manage their affair, the property affair. Like it has nothing to do with tax filing altogether.
Yeah, so you may not think to tell your client.
Exactly.
Neither party would know. Neither accountant nor client would necessarily know that they need to disclose that.
Yeah, exactly.
To each other.
Yeah. So then those are the I guess. It's harder to notice, but a lot of the time we remind our clients, hey, if you have a trust agreement, if you're reporting entities is different from what's being on your legal title, then there is a trust relationship and you have to file.
And then what should people expect to pay for these things? Is it a per trust agreement, per trust relationship?
Yeah, so
know how much they have to pay for this.
Well, there are ways to get around it, but typically each trust relationship, because if I own things in trust with my mom, in trust for my mom, that is one trust alone, right? Mm-hmm. If I own anything, for example, the property that we share, you are on title, but you don't own anything. At least in my mind, you don't. There's a property that you go on title because back then you were required to go on title by the bank.
Yeah.
But I've always
reported for the mortgage.
Yes.
Yeah.
I've always reported that as my income because it was my pre-marriage house that I had, right? So I always reported the income and expenses. There's no disposal. You're not entitled to anything. Mm-hmm. And so that is also a trust. So you own that property in trust for me. Mm-hmm. So that's a different type of trust altogether.
Complicated.
So my name is on my mom's property. I'm the trustee for that particular property. On this particular property that we own together, or I own 100% that you're on title in trust for me, that's a separate trust. Mm-hmm. So there is like 2 trust filing that we have to do on top of the family trust. Just so you know, there are 3 trust filing as a minimum at the moment.
May I reiterate to the listener, our 17 listeners, that the ultimate wealth hack is to marry your accountant. I actually think we should start a dating app for accountants.
I don't know what you're talking about.
Yeah, me neither. What else is happening for new accounting changes?
So those are the biggest thing in the rocking the accounting role. There's a couple other smaller ones.
I should probably throw out there as well, like, it sounds like a lot of accounting firms are already tight for resources and capacity. Does anyone really want to do more of this?
No. So I was just having a conversation with a U.S. accountant, an accountant from Boston. She's telling me that the accountant in the States, they're short by $300,000 this year. Next year, there will be more shortage because fewer and fewer people are going into accounting, right? So as an accounting firm owner, we don't want to do as much. Yeah. It's just unfortunate that the government essentially making up all these rules, new reporting requirements.
More accounting requirements. So if anyone's considering a career with good job security and great pay.
Yeah.
And then, how does anyone know how much they should budget for trust reporting?
Typically, trust reporting is like anywhere, depending on the return, the type of returns that you have, the number of them, anywhere from $700-800 all the way to thousands of dollars, right? Yeah, depending on the type of trust that you were talking about.
So this is tough. This is especially tough in this market when so many people aren't cash flowing on their real estate.
Agree.
I was talking to a friend of ours. He's a downtown Toronto realtor, and he was telling me how he's an engineer, so he's smart as crap. It takes to buy a condo today to make it at least break even on hard costs would be 50 to 55% cash, as in like there's no interest on that cash, and that just covers mortgage, taxes, insurance, and condo fees. That doesn't include vacancy allowance, bad debt, repairs and maintenance, property management, and property taxes supposed to be going up 10.6% or something like that in Toronto. That's if the federal government kicks in, I don't know how many millions of dollars. If not, then it's going up to like 16%. So it doesn't cover that property tax increase. And now we have all this extra reporting requirements and accounting costs. Can people do it yourself? Trust reporting?
They can try. Oh yeah, like people do their own personal tax return all the time, right? So
I did when I was a T4 employee, and that was it.
Yeah.
As soon as I had properties, I transitioned out of that. So people can try. Do you have YouTubes out there how to teach people how to do it themselves?
No.
That kind of opens it up to a massive amount of liability.
Glad you realized that.
Yeah. It's not the best idea. Maybe someone else can do it up there. Yeah, there's another business idea for somebody out there if they want to create YouTubes on how people can do their own trust reporting accounting. So what else is going on with the real estate investors from your perspective?
Recently, there's also this new latest update on the Airbnb, and people are the federal government just announced that you are not eligible to deduct any expenses if you operate a short-term rental in the area that do not allow short-term rentals. Yeah. So the most notable area would be Toronto and Vancouver, right? Yeah. So these are
all of BC, right? Because it's province-wide for BC. Yeah.
So then you know that in those areas, if you own a short-term rental, you are not eligible officially to deduct any expenses. Yep.
This is going to be tricky as heck because for Toronto, for example, you're still allowed to rent an Airbnb space in your home for a certain number of days a year. So yeah, but again, it's all municipal level on who allows what they allow, and to prove this to the government that your unit's okay.
Yeah.
This is wild.
How do they know?
How do they know?
How do we know as accountant? We can only talk to you. Yeah. Hey, are you operating Airbnb? Yeah. If you're operating Airbnb, are you operating in this area? All we can do is we file taxes based on whatever the clients told us. And then wait until CLA to come back to audit.
Scary stuff. And then the bigger story, part of the big story about Airbnb is I just saw another headline today that prices in certain cities in BC are collapsing. Like for example, there's a whole building that was intended that's like 80% Airbnb because the condo building allows Airbnb. Now the province no longer allows. So the building's no longer allowed. And so prices are just collapsing because like you can't cash flow those things. In a regular rental.
Yes.
Yeah, that's why. Yeah, we like to stay in Airbnbs, but I don't think I could operate one. And I understand why people are doing it because it's pretty much the only way to cash flow in a single family home in Canada, in BC, Ontario. Yeah, I feel sorry for these folks.
Well, it's not just the only way to cash flow. It's also the reason, coupled with the reason of how difficult it is to collect rent when you cannot, when you have a bad tenant, right? So that also doesn't help, right?
We covered that extensively on this show. Yeah. It's sad because, again, like I said, it's really tough out there. And one of the reasons why we never did Airbnb, we didn't have a great experience with our own Airbnb. We weren't able to make money with it. Again, it was more like the location that was wrong. Being in the suburbs of Hamilton, the lesson was, and also because we have friends that are successful doing so, you need to be in much better walkable areas because it works for we have friends what it works for. But for all the folks who are like just like they have no plan B, plan C, because we have plan B. I can sell it. I'm in a hot area, and that's why it sold quite quickly. But yeah, for plan B, plan C, long-term rental wasn't an option for us because we wouldn't be able to cash flow it. Yeah, there's not really many options for cash flow and for and risk management in Ontario and BC. Yeah, which is why we're selling two of our properties right now. We have another one going live today. I don't know if you know that.
No.
Yes, we divide and conquer. So I'm sure people are interested. How do we make this working relationship work?
I'm not really sure if people are interested, but sure.
Well, when I was asked to speak at CRUA, Canadian Real Estate Women's Association, that's all they asked for, is how do we make this relationship work? How do we make this work?
All relationships are about compromise. Your heart just need to be big enough to forgive each other mistakes or things that you don't like.
There's that, and also we had common interests. Like you were already looking to become a real estate investor yourself before we even met.
Probably. I don't think I was able to become real estate investor because I was tied down to the biggest mortgage of my life at the time, which is the townhouse, Toronto townhouse that I still own today. Right. It was the biggest mortgage on single income. It was really expensive. I just didn't have any cash left. I would live paycheck by paycheck.
I still remember when you were telling me how you'd use, when you were bored at work, you'd surf realtor.com, realtor.ca.
Yes.
And you were looking at local properties.
Yes.
But the quick math was easy. You can't make these things work.
Yes. I was trying to find a property in Etobicoke, actually in Mimico area, for those of you who know Etobicoke.
Which is a hot area.
So I was trying to find a property that I can buy like from using the proceed. If I were to buy anything, I would have to sell my townhouse and buy a property that's decent enough that I can rent out the basement. So that was what I was looking for at the time. So that I don't need to live in a 3-bedroom plus 1 den executive townhouse that has 3 bathrooms, because at the end of the day, I could only use 1 toilet at a time. Yeah. So
you only have 1 ass.
Yes, exactly. So that was what I was looking for, like something that's somewhat decent that I can rent out the basement, so then it helps with me with supplementing my income.
Right. And you're not alone, because again, my Toronto realtor friends are telling me that duplexes are on fire in downtown Toronto. We're recording this on Valentine's Day, obviously, so it's February 14th. And again, it's downtown Toronto that's on fire for the same reasons that you just shared. People are looking for mortgage help from their basement for one of the units in their property. So the hopefully it comes up to comes up to Hamilton soon enough, and our market recovers. But do you remember the first property we bought together?
Yes.
What about it?
What about it?
Where is it?
Oh, okay. So it's in St. Catharines. It's a six bedroom student rental. It was a single family home at the time, so we converted it into a 6 bedroom, essentially upstairs and downstairs type of arrangement. 6 bedroom for kids, for university students to rent.
Yeah, Brock University students. Do you remember even seeing it? Do you remember the process? I remember it quite well.
Yeah, so I was still working for Loblaw at the time, so I didn't have the time or the luxury to drive out to St. Catharines to look at properties. So the way it worked was that I refinanced my Toronto townhouse, and I have like maybe $40,000-$50,000 line of credit available. So I decided to then
Sorry, after refi, you had $40,000-$50,000 available?
line of credit, yeah, or maybe $60,000. I don't remember.
Right.
off the
Secured by your house.
Yep.
Yeah.
And you said that it would be it would be nice. These investing in St. Catharines student rental would allow us to cash flow. I said, okay, so I could refinance the property and then see what's available. And you went out to see the property. And then that's how we bought our first house together.
Yeah, I just happened to be driving around the area. So again, I remember it well because I was there. I was driving around. I saw the for sale by owner sign. And I knocked on the door.
Yep.
Can I share what we paid for it?
Sure.
Paid $235 for a 1,000 square foot bungalow in what my good friend told me was an A+ location. And that's the property we're currently selling right now and have a conditional sale on.
Yep.
Hopefully it firms up by Friday.
Yep.
And it's gone up significantly. So I want to say I'm glad that we have a diverse portfolio because we have duplexes and we have student rentals.
Single family home. And also office.
Yeah, diversified. Because of our distance, like I mentioned how Toronto was on fire.
Yep.
Right. My friends are telling me the December was the busiest they've ever had, even over Christmas. They're just insanely busy for anything that was on the land. So I'm glad we have student rentals because those have demand, unlike our duplexes with long-term tenants.
There's demand for rental, just no demand for purchase, I guess.
Yes. The student rentals have demand for both rental and purchase versus our duplex, tons of demand for rental, almost no demand from investors, at least in Hamilton and beyond where our properties are located. So I'm glad that we have student rentals because our plan is to exit them, and we're planning on moving our capital to the States.
Yep.
So I keep getting questions around because, for example, I shared your Instagram story about how to exit Canada from a tax perspective.
Tax implication on leaving Canada permanently.
Yeah, we should probably touch on that a little bit. But I keep getting the question, are you leaving Canada? Are you moving to Texas? So no, we're not leaving. Am I right?
No, we're not.
Yeah. Okay. So so just so we're clear, it's only our capital that's leaving because we want to go invest where it's less risk and for improved cash flow, and there's no rent control.
Yep.
Right. So can you share? Because I think listeners understand how I appreciate that. I generally don't have to worry about the tax and accounting side because I know you got that covered. So what's your accounting perspective on all this?
So I guess the plan for us specifically is to exit at least a portion of our portfolio and then buy a couple of properties in the States to begin with. And then we'll see how it goes. That's always in my head. I don't know Erwan's plan because Erwan seems to have big plans all the time. And at least in my head, we're about exiting a few properties and see where it takes us and then see how the US portfolio will take us. And from exiting Canadian properties perspective, you do have to realize any capital gains that you have.
There's no avoiding paying tax.
There is no avoiding paying tax. And I'm
pretty sure there's a common question you get.
Yes.
I made all this money. How do I avoid paying tax on it?
Exactly. So then there is no avoiding paying tax. And you have to make sure that I was just having this conversation with you earlier. We have to make sure that, hey, we actually set aside enough money from the proceeds to cover off our own tax liability before we move all the capital that you get from the lawyer to go into the States. Now, with respect to buying properties in the States, my understanding is that you have to be really careful. From a Canadian tax perspective, buying properties in Canada versus buying properties in US or in anywhere else in the world, the best case scenario is that the Canadian government would treat the purchase or the profit from the rental operation out of country the same way as if you are investing locally. That's the best case scenario. Now, what's the worst case scenario? You pay double taxation. That's the worst case scenario.
Yeah, someone screwed up though for that to happen.
Exactly. So,
and that's incredibly rare. Like someone has to be negligent for that to happen. Am I right?
No. So it is actually way more common than you think it would be, because a lot of investors out there are going to local people. For example, in the US, they will go to a local lawyer, and lawyer or local accountant who do not know anything about cross-border tax would immediately go for do LLC because there's no double taxation, there's blah, blah, blah.
So they had the wrong setup.
Yeah, they treat it as if you are a local U.S. citizen or local U.S. green card holder. So it's a very different ballgame when it comes down to foreign investment. So you have to talk to people who are aware of the tax implication and set you up on the right track. I have so many people that I know that set up LLC for their own investment. LLC is called limited liability company, I think, but it's a flow-through entity for the US side, but it is recognized as a corporation in Canadian side. So there is that mismatch, and therefore you will pay double taxation if you own properties in something called LLC.
Right. So folks need to have the right accountant on this side of the border and on that side. So yeah, and no different than everything that we do in investing in Canada. Absolutely. You still need the right team. You still need the lawyer, the mortgage person, and your accountant all need to speak the same language.
Absolutely.
Because whatever's best for each of those worlds may not be the best. Like the best corporate setup may not be the best for getting financing.
Yeah.
May not be the best for tax minimization.
Absolutely. Yeah.
Right.
And also, the thing is, it's also important to understand that now you have, once we are venturing outside of Canada, you are operating a multinational business, believe it or not. So multinational business means that you have increased your the complexity of filing at least double, right? Because now you have to file US tax, and then in Canada we also need to report it. So now you're increasing the compilation costs. Now I'm saying that because a lot of people would come to think when they come down to investing in the US, think really straightforward, but there is that complexity, the compliance complexity as well. I just want people to be aware of it. We're still going ahead with it because there's cash flow to cover the expenses, but I also want to mention it so that people don't need to actually get a realistic picture of the costs associated.
So you've looked at a lot of real estate. You're like the most popular real estate accountant in Canada. People tell me all the time.
I don't know about that, but sure.
That's what they tell me when they run into me in public and ask me where you are. I follow your YouTube. I follow Cherry's YouTube. Hi. Nice to meet you. From an accounting perspective, from your professional perspective, do you see any downsides for a Canadian to be investing in the States? Other than double taxation, which we mentioned, but it's avoidable if you do it correctly.
I think yesterday I just had a conversation with Carmen, who's the CFO of this company that she co-founded called Share. And they specialize in helping people to purchase properties in the States, particularly Canada. So they all purchase single-family home in the States. And from what I can see, it really goes back to the person's preference. But for me, it works because there's cash flow. And
we're conservative people, so we like cash flow.
So yesterday the conversation with Carmen was that, hey, she bought a bunch of properties because she exited a business and had the resources to buy a bunch of properties. And she's buying properties that are Class C properties to
I
generate
think
the cash. I don't know about C or D, but generating enough cash flow.
Yeah.
Now she's venturing outside of that Class
Apologies.
C.
Let me clarify. Because when she was buying those condos in Florida, they probably weren't that bad. I was thinking about more her upstate New York,
Yeah.
like 50 grand propies. Sorry, I go ahead.
So the example that I was given was that she was buying these Class C properties, and she was able to refinance them and then diversify and buy Class B or Class A property using the refinance proceed for it. So essentially, she will still buy properties that are properties that would have more upside in terms of appreciation, but she used the money she has, the cash flow that she has from these Class C properties to purchase those better quality properties. But that concept is essentially treating your real estate investment portfolio like a real business. A lot of people in Ontario, especially Canada, because they don't have a choice, they're buying properties here, negative cash flow. How much negative cash flow can you sustain on a monthly basis? Like, just look at that few $100s. It adds up. We're talking about a few $100s, thousands of dollars a month. It adds up. Do you have that deep pocket to pay for that thousands of dollars of negative cash flow on a regular basis?
We had someone in our office who's negative cash flow $6,000 a month on their condo portfolio.
Yeah, exactly.
Downtown Toronto condo portfolio.
Yeah.
It's not necessarily, like, what business would accept that?
So $6,000 is equivalent to $72,000 annually. And that's before tax dollar, but still $72,000 is someone else's job. Job
Well, that's
income.
more than the average Canadian makes.
Yeah, exactly.
Yeah.
Do you have that deep pocket to sustain that type of loss? Is it a really sustainable business model? Like, if you're counting on appreciation alone and sucking up all the negative cash flow, monthly cash flow, your appreciation is not really the amount of appreciation that you're seeing. You need to take that and minus all the cash flow that you've put into the property as well. People often neglect those when they talk about real estate appreciation and investment, right?
From a tax perspective, are you allowed to use those losses, like for as long as you have the the negative income property? Are you allowed to use those those losses to count against your income?
Generally speaking, if you are trying your best to invest and you're trying your best to generate income, and you're not leaving the house vacant, there is activities going on,
Right.
Then generally speaking, you would be eligible to deduct the expenses.
Because generally condo investors, like, they have no hope in hell from the beginning of cash flowing. And so that's still a lot to be deductible. That's interesting. That's surprising too. Which is why I don't understand why. So I actually think that what we're doing with share is going to disrupt the entire market. Because the properties that we're looking at, the properties we're going to be buying ourselves, the forecasted appreciation. Again, it's a forecast. You don't know. But we're buying in the suburbs of the top towns in the USA. So even though we're using 5% appreciation, which is reasonable in my opinion. I've been around for a long time. So why would I accept negative cash flow?
There's also historically in Toronto, there's also 5%, 10% appreciation.
7%,
Yeah, so there's that appreciation.
That's
That's why
historical.
they are accepting negative cash flow in exchange with that appreciation.
Yeah, it doesn't sound like a good investment. What else about U.S. investing are you interested in?
Well, right now I'm waiting to co-host this webinar with Share, whereby Share is going to share their essential process of how they would be able to help investors. Because I think one of the biggest obstacle that we see on the street in terms of buying U.S. property is, how do you start? Where do you start? Do you just engage with a realtor? How do I know that that realtor is right or wrong?
Yes.
And which town should I, because it's so
a huge
big.
country.
Yeah, exactly. Where do I start? So I wanted to host this webinar. One is to share with the world what Share is doing. Two is to help me understand the entire purchasing process as well, because we're about to embark on this journey. Ourselves. So this is a learning experience also for us in general. Also, I want to be able to help others, and so we are hosting this to share the information.
And I'm presenting as well.
You're presenting because you've been to Texas and Atlanta to do your research. So I wanted to know, essentially I treat it as, hey, Erwin now wants to embark on this journey, and this is kind of like a presentation, a pitch presentation to convince me that I need to have this buy-in to invest in the US. And that's what I'm trying to do. And the webinar is happening February 29th. And the registration link is on my website. And my website is realestatetextips.ca.
We'll have a link in the show notes as well. So I was in Atlanta in November, and I was in Texas. I was specifically in San Antonio and Austin in January. And I wish you were there, because Texas was... The whole southern hospitality thing, I had no idea that it went all the way to Texas as well. Because I've been to Florida, we've been to Florida together, and that's supposed to be southern as well. It's fine. No one was really rude to us, I would say. But like in Texas, people are just over the top hospitable. Right? It's the best service for everyone I've ever seen, from the Costco cashier to the McDonald's cashier to the hotel staff. To everyone. The service was outstanding. I felt so comfortable. I wish you were there to see it.
It's okay. We got a lot of chance, especially if we were to buy a property over there.
Yeah, because I don't know where we'll buy first. We'll probably buy either Austin or San Antonio area or Atlanta first. And then until we make our own visit to Tennessee. Do you want to go?
Maybe.
May? In May? Month of May, not May. I don't know. For my comfort level, I like I like to go do site visits, get a feel of things.
So he's going to share all your research, right?
I only have 20 minutes. I can't share all my research.
Well, the reality is
give me 2 hours.
That
Give me 10 hours.
I get Erwin that talks about this bits and pieces all throughout the week or the months, and I can't comprehend the whole thing. So that's why he's given 20 minutes, condense his own research into 20-minute segment in my webinar. So you got 20 minutes to present your research. All I know is you need to look at all these economic factor, population growth, and then historic rate and major industry, all these things. I'll let you do your thing.
Yeah. Do you have any concerns with the U.S. investing?
It's far.
It's kind of good. It's okay. Yes, it is far, which is why part of my requirement was that we would only do this if we would have the best of the best property management that was available. And we're going to get it for cheap too. Because we're going to an asset manager.
Yeah.
Right. Because with Ontario, I tell my clients all the time, your greatest risk in Ontario is your tenant. If they don't pay you, you are in so much trouble. If they refuse to pay you and refuse to pay you for months, you're in so much trouble. Right? Versus in the States, you don't have that. 30, 60 days, your tenant's gone.
Yeah, it's a very different scenario out there. It's really hard in the marketplace. We have actually, my uncle just recently told me he had a friend who's owned a property in Barrie and rented out to a couple who's a couple in their 20s, and said I decided not to pay you, and if you want me out, pay me $17,000 and I'll be out.
Just pick that number out of the air, 17,000.
Yeah. I don't know, 17 or 20, whatever. But that number is out of thin air, because they know that they're going to be, they know that they would either get it from you, or you'll have to pay that $17,000 over a number of months because they're not paying you rent. And then by the time you get the ruling in favor of you, then you would be able to kick them out maybe a year later.
Yeah, it'll cost you more than $17,000.
Yeah, exactly. That's why they are counting on that, and that's why they get the $17,000.
That's so nice of them to meet you in the middle. It's going to cost you 9-12 months of rent, of not getting rent, or just pay me $17,000. I could have asked for more.
Yeah,
that's so nice of them. And that's the sad thing, is that more and more this is coming out in the news more and more, and people are DMing me about this as well. I had a friend tell me that his friend has a realtor living in his condo and refusing to pay rent, owes him $23,000.
Jesus.
Right?
Yeah.
And so the tenant is a realtor, so they fully know the rules.
That's what you think. They fully know the rules because they're not paying. Yeah.
Yeah. So you fully support my decision to move our capital to the States? Slowly.
I think I am right now in support of exiting a portion of our portfolio in Canada. Now, whether we're going to the States or not, we have to wait until February 29th to watch that video, to watch our webinar all together, and then we'll see how it goes. Yeah.
Because I don't think we don't necessarily want to sell everything this year. First of all, the market hasn't recovered. I think we can sell some of our properties back at the peak prices if we wait till probably the end of next year.
So I think I wouldn't call it selling our whole portfolio. That's not really our intention, my intention anyway. Maybe in your head you are thinking that's the case, but I don't think that is really my intention. I think it's about risk diversification, right? Like, if we are always in this rent-controlled environment, what if one person is not paying us, and what's going to happen? What if two people are not stop paying us and asking for $17,000? Do we have $17,000 or $34,000 in the bank account to kick them out? I don't know. It is a crazy time in Canada, I have to say.
It's totally sad. That's probably why I want the market to be hot as well, so that folks can just move in and whatever. At least, thankfully, we have a good relationship with our tenants. We've been, I'm pretty sure almost all of our tenants will say, like, we're the best landlords I've ever had. So hopefully karma.
Yep.
Hopefully.
Yeah.
Hopefully. But also I see that the only path to cash flow $100,000 a year is through U.S. income properties. Because we don't have that with our portfolio, and I don't see how we're going to get there, especially with rent control holding down our rents.
Absolutely.
Like top of mind, I think we have more. We have at least 3 properties that are under rented by over $1,000 a month.
Yeah.
Right? That's $3,000 a month right there. That's $36,000 a year. We should have more in our pockets. So
absolutely.
Yeah. So I want to sell all those too.
Well, like in this market, it's too early to say.
It is too early. But my forecast is we should be back to peak by end of 2025 or 2020, and sometime in 2026. So it makes sense to slowly sell, maximize our profits, and then by exiting, we'll minimize our grief.
We'll see where we're putting our capital.
Any other investments you're finding your clients where it's working? Like, you have clients in everything. You have clients doing developments, you have clients doing short-term rentals, you have clients doing private lending. What's working?
We don't see a lot of what's working, to be honest. We see a lot of what's working when they exit the property. We don't see a lot of cash flow.
Right,
in
like a developer,
Ontario.
you wouldn't know until they exit.
Yes, exactly. We don't see... we see a lot of losses recently in the last couple of years.
Right.
We see losses from private lending,
crap.
losses. We see a lot of private lending losses that are not even eligible for tax deduction because they invest in RSP or TFSA.
Oh, no.
So then you don't get anything. You lost the money. That's it. We see people who lose money on flipping their properties. They are inexperienced flipper and they lost money. They got caught in this market, lost money.
And these are the same people that people were lending to.
That I don't know, but they are inexperienced.
The ones in the
flipper.
news are the ones that are borrowing money in their inexperience.
And then we see people. Generally speaking, I still see some people investing in private lending, but not as much as before. Everyone is negotiating their fees and thinking that wanting to find ways to cut their expenses as well. Those are the market conditions right now. It's not that easy.
Right.
And simple.
Right, because I already know enough people. There's plenty of people who let their property managers go because they couldn't afford them. Yeah,
absolutely.
Which is all the more reason you need to cash flow on these income properties.
Yeah, absolutely. People think that cash flow is I think cash flow is totally underrated by majority of the real estate investors there. Yep.
I'll throw out there that people believe a lot of the marketing that's in front of them. I literally had an investor whose negative like $1,500 a month on 3 different condos. And he told me, like, because he bought based on a pro forma provided by whoever was selling the pre-construction condo, and he only focused on ROI. He didn't look at what the cash flow was.
Yeah.
Which is, for my team, we always start with cash flow.
Yep.
Here's what we think here's our cash flow calculator. We'll give you all the inputs. What's the cash flow going to be? Are you okay with that? Versus an ROI number based on an appreciation rate. And that was for the last few years that didn't work out.
I think that's very common when you sell a condo, pre-construction condo in like Waterloo area. I think because people are selling those student rental and they want guarantee house, guarantee price, guarantee rent. We've seen some of these pro forma as well.
Yeah, we were advising clients against that. For anyone who doesn't believe me, to go drive around Waterloo and you'll see how many buildings they build all at the same time.
I think I wanted to take a memory lane, a trip down the memory lane. So I went to Waterloo.
Instead, let's drive to Columbus, Ohio. It's a good place to invest. What other taxation stuff that should people pay attention to? Like record keeping. I was just talking to our min assistant. Apparently, I'm missing some receipts.
Yes. So there's a lot more that we need to do in terms of record keeping. People are not aware, and it is hard to educate people. What I found, I can start with our most troublesome clients. Our most troublesome clients are always the ones that are growing really fast and doesn't have an integrator or doesn't have someone like a strong administrative assistant and doesn't believe in having one at all, thinking that they could do it all by themselves. Right. Those are the people who I wouldn't say fail the fastest, but you can see that when they come to us, they have nothing prepared. They said that they have something, but everything is messy. It's not possible to lend you money based on the set of books that we prepare. We try as best as we can to make it meaningful and as representative as possible, but there's garbage in, then there is only garbage out. Right. So,
and these people need to refi.
Yes, exactly.
Usually on short notice.
On short notice. So they come to us, things are half done, half not done, messy, and then they want things done yesterday, which is not possible. Those are the biggest risk in terms of record keeping, because they don't have any support for any of the stuff that they do. And it goes back to, hey, when you have a big plan, it's really important. I don't know about the coaching courses out there because I've never taken one. It's really important to have someone who are detail oriented and super organized to help you out, because if you don't have that person, chances are you are going to mess up. And now going back to record keeping, it's part of that person's responsibility to do strong record keeping. If you don't have that person, you're a small investor, you're comfortable with it, it's all fine. All you need to do is pretty much get some brown envelope, stuff all your receipts in it, and make sure you just keep all your receipts that can be proven to be deductible into that envelope. And at the end of the year, look at all of them and then categorize them. That's all you need to do. Right. It's as simple as that. If you don't want to use a physical folder, all you need to do is take pictures and send it to an email address that's dedicated, or save it in a particular folder that's dedicated for that particular property or business. It sounds simple, but it's really hard for some people.
Is there an app for this?
You can use an app. QuickBooks Online has a function to allow you to take pictures directly. You and I use something called HubDoc. I have a different set of reasons why we're using HubDoc instead of QuickBooks Online. There is also Dext out there that would allow you to do that.
How do you spell that one?
Dext, which was formerly known as Receipt Bank. It's called DEXT, Dext.
And then what is the process? Like, say their record keeping is good. And then what does the accountant have to provide so that the investor can go get their mortgage?
Typically, if you own properties in your personal name, so they would ask for your personal tax return and the schedule of statement of rental income and expenses. And then they would ask for a couple of years of your tax returns. Now, if you own properties in a corporation, then it gets a little bit more complicated. They want to see the financial statements of your corporation. They also want to see essentially the proof of property tax, insurance bill, rental for all properties that's held within the same corporation. And plus, they also want to see your personal tax return.
Right. And sometimes they may want your personal tax return like as soon as it's available.
Sometimes they don't. Yes. So depending on the lender and the timing as well, right?
I'm gonna guess most investors who are like really rushed, they usually are more complicated, and the requirements will be higher from the lender.
Yeah.
And so I think investors need to understand, like, if your like almost so many people's strategy is to refinance, like get it done quickly in a timely manner, whatever it is, renovate it, rent it out, right, and then refinance it.
Yeah.
So for this to go smoothly, their books have to be in order.
Oh yeah, majority of the people are only putting things in order at the time when they need to, when they file the taxes. Yeah. Which
makes rushing. Yeah, so it could take a while then.
Absolutely.
And it's not their fault necessarily. They're just busy. If they're trying to do everything themselves.
Yep.
And if there's not cash flow to pay a bookkeeper or an assistant or whatever. So this is probably an unexpected delay in getting people's financing as well that people probably don't see.
Yeah, absolutely.
And you're probably not making any friends with your accountant if you're putting garbage in.
No.
What else should investors know about?
Record keeping is one of them. Understanding, keeping up with the latest rule is a second one. People don't like to be told that they need to do all these filings. We try our best to tell our clients as much as possible. Sometimes we even go as far as texting them just to tell them that, hey, you may have this filing obligation. Make sure that you watch out for these. I think people don't pay enough attention to it. They tune out altogether.
Can we talk more about private lending? Do you folks dig into it at all in terms of like what the common errors are?
Private lending?
Yeah, you mentioned like that seems to be a painful area for people losing.
Yeah, so a group of our clients have invested in different type of private lending situation and got essentially didn't recover their initial investment. So when you do private lending, it's in a few different forms. The first one could be in something called a second mortgage or first mortgage. You're the first one.
Good. So they have security.
Yeah, first mortgage means that you have first security, first right. If the borrower doesn't pay you, then you can go back and liquidate that property.
Yeah, and you're the first to get paid.
You're the first
after the government gets their taxes.
After the lawyers and realtors get their first cut first, then you're the first one that get paid. Now, then it's second mortgage. Second mortgage generally is higher risk. You're ranked second, meaning that you rank after someone else who's the first lender, who has the first right to the proceed if something goes wrong. And you are in a higher position because now you are exposed to higher risk. And so usually the interest on the second mortgage is higher, but you're still registered on title, hopefully, because sometimes they don't get registered on title for whatever reason. Administrative error or whatever, they don't register. Now, if you're registered on second, you still have a chance.
Sorry, just dwell on that point a little bit. Like you get paid a rate, but if you're not secured on title, you're actually taking out more risk.
Yeah, absolutely.
So now you're not getting a return appropriate to your risk.
Yep. Sometimes it just doesn't happen. Now,
good Lord.
And then afterwards, typically there's like obviously third, fourth, fifth position, right?
And contractor liens we're seeing now too. We're seeing municipal property taxes not being unpaid, utilities. Yeah,
but we're talking about third, fourth, fifth as in like being a lender.
Yeah.
You're talking from a different perspective.
Now, I know, but they could be behind someone else.
Yeah.
They could be behind.
So once that's being done, as you know, if you're a third lender, your risk is higher than the second. Now, let's say actually in the last few years, it's really popular to lend based on something called promissory note. So promissory note is essentially IOU. You come up to me and say, I want $100,000 because I'm trying to renovate this property, but it's not registered against the property. So you don't know how much is being registered already against that particular property. So you still lend me the $100,000, or I still lend you the $100,000. It's not secure against anything. If that person goes bankrupt, the whole promissory note is gone.
Yeah, even if they give a personal guarantee, if they go bankrupt.
Yeah, then it is what it is, right? So those are what a lot of our investors are losing money, the type of instruments that they're investing in. Because at the end of the day, if you're secure against a property, you have a chance to recover.
Yeah.
But if you own promissory note, they have to sell those properties, pay the first and second before it gets to the promissory note repayment, right?
Do you know if any of these people are actually taking over the property? Or they're just writing off these losses?
Well, depending on who and what the position is, right? We have our best friend actually was in second position. I publicly talked about her situation before, and she went ahead to pay off the first loan and then take over the property and purchase the property off.
And pay the legal fees for the power sale process having started, which is over $10,000.
Yes, she has to pay out of pocket an additional $10,000 to close the property.
Great passive cash flow investment.
And then she ended up making money on the sale because that happened a few years ago. So the market has gone up. She's owned it for a year or two, and then she ended up making probably $100,000 or $80,000 or something from the property. But she said that she's never going to go into this private lending ever again. Because
after she told me that story, I was never interested in private lending. Because again, pretty much everyone goes into it wanting a passive investment.
Yep.
And then if it doesn't work out, it's bad, right? Like she had to pay the first mortgage.
Yep.
So what's supposed to be a positive cash flow play is you're paying someone else's mortgage now.
Yes. So imagine
there was no tenant. I believe it was the owner that lived there.
Yeah,
so there wasn't no rent.
No, there's no rent. So there's rental income after she bought the property, but there's no rental income.
So she had to bleed for a while.
Yeah. So for those people who are into promissory note, this option is generally like there's no point to go through this whole process, right? You're not secure against the property. So you're not essentially getting anything out of it. You're really just helping to buy out that property and pay off your first debtor, first mortgagee, and also the second one. You're not even the third ranked the third, so there's no motivation for people who are investing in So there's no reason for you to do that, other than hold on to the property and hoping one day. Then in that case, you can hold on to any property, hoping on one day you're going to recover the loss that you incurred, right?
There's plenty of history of what promissory notes being wiped out.
Yeah.
I'm shocked that people still do it. Right?
Greed.
Unless it's a special situation.
I think it's greed. And like 15% interest rate, 16% interest rate.
I think some of these on the most recent story was 17. That's what I was reading in the news. Is there a line item on your tax return for a greed write-off? I can declare these losses due to greed.
So if these losses are incurred in TFSA and RSP, like I said before, they're not written off, right? But if these loans are registered in your own personal name or in the corporation that you own, then you can report, generally speaking, you can record it as a capital loss. So it's not immediately offsetting against all your income. It's only when you report capital gain, you would be able to offset some of these losses.
Only against capital gains?
Yes.
It can't be written off against other corporate income?
No, just capital gain.
Damn.
Generally speaking. Like there's exception. The exception is if you operate a mortgage business altogether. But how do you prove that you're more of operating and really mortgage business? You have to be very highly specialized. Majority of us do not qualify. Let's just put it that way.
You're just making this sound even worse because like interest income is taxed at the highest rate.
Yes.
And then my losses or deductions are at a really low rate. I can't deduct as much. Or none if it's TFSA or RSP.
Yeah.
And again, if I make the income in an RSP and TFSA, I'm paying max tax. This just sounds even worse.
People generally do not consult with us either because we're accountant. We're like at the back end. We're only looking backward. After they made a decision at the end of the year, oh yeah, by the way, I have this interest income. That's how we find out.
Right. No one talks to me either.
Yeah.
Is this a good investment? Oh my God, never touch that. That's how, yeah. I'm not saying all of it's bad. I think some of it can work, but I think those are rare cases. I think those are very, very, very specific niche case where I think a promissory note works. Any other advice for real estate professionals? Realtors? Anyone? Builders? Contractors?
I mean, there are rules that just came out September 14th, 2023 for HST. If you, a lot of people don't seem to realize that if you build a purpose-built rental, when you complete the purpose-built rental, you're required to pay HST on fair market value of the property to get the government.
Right.
You buy a piece of land, you build it, you pay the cost to build, you pay the HST to the builder. Now, at the time when it's ready for occupancy, you now have to do something called self-assessment and pay 13% on the fair market value of the rental to CRA, because as if you were to buy it from someone else brand new. Now, you can pay that 13%.
Wait. Where's this money come from?
From your own pocket. You have to pay it.
I understand when developers just collect it from the buyer.
Yeah,
but
exactly.
There is no transaction here.
So in the
There's
excise,
no disposition.
yeah, in the eyes of CRA, essentially you are the builder, so you have to charge HST to someone, but you're also the buyer because you're the landlord.
Oh, nuts.
So then you have to pay that delta to CRA. Now, majority of us aren't developer, aren't building purpose-built, but this rule has been around for a long time. Right. So you have to do self-assessment. Now, CRA came out and said, well, we recognize that is added cost to purpose-built rental. So we decided to essentially waive that. And we will also refund any HST that you pay prior to it, provided that the construction of this purpose-built rental is 4 units and above.
Oh, crap.
Or have 10 bedrooms and above. Now, conversion from residential property doesn't count. And the construction has to start after September 14th and after.
Sorry, what do you mean by conversion of residential property? Like you can't take a 5 unit into a 10 unit?
No, that doesn't count.
You have to pay HST on that?
You have to pay HST on
even though you didn't sell it?
Yes.
It's just treated as if you sold it to yourself. And
yes,
pay all
exactly. But if you convert commercial to residential, then that counts. I mean, the legislation is still up in the air a little bit, so we're still waiting for the final legislation. All these final detail has to be ironed out, but it matters. I hope so too. Yeah.
Because they need to encourage people to go, build from 1 unit to 10 unit, whatever.
Yeah, absolutely.
Right. But I was thinking about the common example where people ourselves and people in our community, they do basement apartment or garden suite. Do those have HST implications?
Depending on whether it's considered substantial renovation or not. So substantial renovation meaning 90% and above of your property is renovated. The walls and your floor space is replaced. So a lot of them do not qualify. Now, garden suite, you do have the filing because it's a new structure, brand new on its own. Typically, you do the filing, you pay, and after getting back the residential tenant, the HST rebate, you're eligible to claim a rebate back, but usually it's like $24,000. And so after that, net, you could be ahead by a couple of $1,000s, or you could be behind. Generally, you're behind. There's filing costs everywhere.
Okay, let's use a typical garden suite example. I see ranges from we had a client do one for $300,000. I see people who do fancier ones for $450,000, $800,000. Let's just stay with the basic investor example, probably be $300,000.
Yeah.
What's my HST implication?
You take 300 multiplied by the 13%, which is 39,000. And then you take 39,000 minus the HST that you already pay to the builder.
Oh, but they paid $300,000 for it.
So what's the valuation? Yeah, depending on what your valuation is. The initial 300, it depends on what the valuation is. The fair market value of the garden suite.
Of the uplift to the property or just the garden suite alone?
The garden suite alone. We can get into finer detail, but that's beyond the conversation.
I would imagine just the book value would be sufficient. This is what I paid for. Like, this is fair. We can calculate HST on this. Right. So I pay, say I pay $300,000 plus HST, then.
Then you get $39,000. You don't need to pay tax to CLA because 39 minus 39 is zero.
Right.
And then on top of that, you would be eligible to claim HST rebate. So in that case, you may be able to get like whatever HST.
Okay. So that's not so bad. So I think it's fair that most people can just argue book value. I paid this for it. This is what it's worth.
No.
Damn.
Like, I don't know how to value garden suite. There's not a lot of...
There's not much out there because it's so
Exactly.
new.
So I can't tell you if it is reasonable. You're arguing based on... I don't want to be put in the corner to say that
nobody knows. It's not been tested.
So the HST payable is based on the fair market value of your property. So I don't have the fair market value for the purpose of our discussion. We're just assuming that it's $300,000 and you pay $300,000 for it.
Yeah, I'm still out though. If I had $300,000 cash, I'm not buying. I'm not doing a garden suite. I buy one or two, probably at least 2 houses in the States with that same amount of money. Yeah, which is still, again, this is a fringe situation. Not many people just have $300,000 sitting around.
Yeah, absolutely.
Yeah, which is sad because I don't see how we fix this housing situation in Ontario. Anyways, anything else we should cover? What is your future outlook for real estate? You're still an investor.
It's still a good long-term investing vehicle. I just prefer, for my sanity, I like to invest in cash flowing properties, or at least properties that at least break even. So I don't have to worry about it. Be smart in the future. We aren't as smart. I think we were smarter before, and then because we were doing the conference, we had to switch the mortgage. I think it's important to diversify. We had fixed rate mortgage in the past, and then we had to refinance the property to extract the equity. Not necessarily extracting anything. We were just trying to make room just in case we need the money for doing the conference. And through that process, we swapped from a fixed rate mortgage to variable, and therefore now we're subject to this negative cash flow as a result. But we had this fantastic fixed rate mortgage that we had. And I think diversity is another key lesson that I learned over the last couple of years. Yeah, diversity geographically, diversity in terms of how you borrow money. Right now, we also have a commercial loan. The commercial loan, I decided to opt in for fixed rate mortgage for 3 years because I don't know how the world is going to be like. It will also take a while before the Fed or the Bank of Canada to lower their interest rate.
It's looking like June right now.
Yeah, exactly. Yeah. So by that time, it's a year into my term. So diversification, be aggressive, but also defensive as well. Be defensively aggressive. Just buy properties that cash flow. Do not buy properties that do not.
And I'll just add, I don't know how we break even on anything locally.
Yeah.
I think most people qualify me as someone who knows real estate in Ontario.
Yeah.
Unless you, like I said, unless you have 50 to 55% down in cash for a condo, that's just hard costs. And we all know things that doesn't cover.
Yeah.
Right. So yeah. So based on the criteria you've given me, we don't have a choice but to buy our next property in the States. Right. Or we could buy a student rental. Someone was kind enough to email me when I challenged folks to find me something with an 8% gross rent yield. Someone emailed me, "Oh, we get $1,000 a room in Kingston, Ontario for a student rental."
Yeah.
But that's hardly a scalable strategy because we perfectly know well how the financing works out for that.
Yeah. So the student rental has their own challenge, but so as investment in the States, so as investment in Canada, it's a business on its own.
Absolutely. Any final words you want to share with our listener?
You can find me on realestatetaxtips.ca, or you can find me on YouTube. I have a YouTube channel that share all the insights that we have. It's youtube.com/real estate tax tips, or you go on to YouTube and search Cherry Chan. I'm there as well. And I'm hosting a webinar by the end of this month, February 29th. Hopefully this will be released before then. And so everyone can register. Registration link is also on my website.
And why does everyone recognize you from your YouTube?
Huh?
We keep running into people who know you from your YouTube. The funniest is when we run into an accountant who knows you from your YouTube.
Have we? I don't think so.
We have.
Oh, okay.
Yeah. I remember all of our fan interactions. Oh, at least your fan interactions. There's not that many of them, but they happen.
There's only 17 listeners, just like you. Maybe
That's
18.
That's
18,
why I said
listeners.
they're your fan interactions, not mine.
I only have 18 subscribers,
Oh, okay.
just one more than yours.
Yeah, okay, sure. Yeah. This is supposed to be the truth about real estate investing. Thanks so much for doing this, Jerry.
Thank you.
Thank you for watching. If you want to learn how to invest in real estate from scratch, my team teaches beginners how to use the #1 investment strategy that I personally use in a virtual free training class every month. Go to investortraining.ca/YouTube to register for our next class. That link's also in the description as well. I publish at least 2 to 3 videos a week here, so subscribe if you want to keep learning from seasoned investors like myself and my guests. And if you're just starting out, feel free to ask questions and comment below, and I do the best to answer each of those comments and questions myself. Again, if you're ready to learn the nitty-gritty about real estate investing from a professional investor, register for our next virtual class. That's at investortraining.ca/YouTube. Thanks again for watching. See you in the next video.